Gold just touched $5,000, and most people are asking the wrong question. They're asking, is this the top? But serious capital isn't asking that. They're asking something else. Why are central banks still accumulating? Why are real yields compressing while debt expands? And why does retail participation remain unusually quiet at all-time highs? Over the next few minutes, we break down 3 structural signals, not headlines, not hype, that suggest this may not be a bubble, but an early cycle repricing, and one imbalance that, if confirmed in the next 72 hours, could tell us what phase comes next. The $5,000 question, price versus structure. Gold reaching $5,000 per ounce sounds dramatic. For many observers, that number alone feels like proof of excess. Financial headlines tend to treat large round numbers as emotional milestones. Investors see the price and immediately ask whether they are looking at a bubble. But experienced capital allocators rarely begin with price alone. They begin with structure. He understood that price is only the surface layer of a market. Structure is the foundation underneath it. A bubble is not defined by a high price. It is defined by behavior, leverage expansion, retail euphoria, narrative saturation, and rapid participation growth across inexperienced capital. When those elements align, price acceleration becomes unstable. When they do not, a high price can represent repricing rather than speculation. At $5,000, gold is undeniably elevated relative to its long-term historical averages. But historical averages must be evaluated against structural shifts. The global debt level today is not comparable to 2005 or even 2015. Monetary policy flexibility is not the same as it was 2 decades ago. Fiscal deficits are larger. Sovereign balance sheets are more extended. The macro backdrop has changed, and markets adjust to those changes over time. He began by examining participation. If gold were in a classic late-stage bubble, retail behavior would reflect it. Search activity would spike dramatically. Leveraged trading volumes would expand at abnormal rates. Media coverage would shift from cautious to euphoric. New investors would be entering aggressively, often driven by fear of missing out. Instead, participation metrics show something more measured. ETF inflows are present, but not extreme. Retail engagement is moderate. Mining equities, which often outperform bullion in speculative phases, have not demonstrated parabolic behavior. This divergence matters. In previous speculative peaks, mining stocks tended to rise much faster than physical gold. When leverage and enthusiasm expand, investors chase higher beta exposure. That pattern is not dominant here. The ratio between gold miners and bullion remains restrained relative to prior mania periods. That does not guarantee anything about the future, but it suggests the cycle characteristics are different from prior blow-off tops. He then examined positioning in broader asset markets. Equity valuations remain historically elevated. Corporate earnings yields are compressed relative to long-term norms. When equity markets are priced aggressively, capital often begins to explore alternative stores of value. That exploration can happen gradually. It does not require panic. It can begin as quiet portfolio diversification. At the same time, real yields, nominal yields adjusted for inflation, play a central role in gold's valuation framework. Gold does not generate cash flow. It competes with real yields. When real yields rise sharply, gold often struggles. When real yields compress or stabilize at lower levels, gold becomes more competitive as a store of purchasing power. Recently, real yields have shown signs of moderation compared to previous peaks. That shift changes the relative attractiveness equation. He was careful not to draw exaggerated conclusions. A moderation in real yields does not automatically imply sustained upside. It simply reduces one headwind. Markets are dynamic systems. If inflation expectations change or growth reaccelerates unexpectedly, the yield environment could shift again. But structural repricing often begins when headwinds weaken, not when conditions are perfect. Another important layer is central bank behavior. Over the past several years, sovereign institutions have increased gold allocations at a pace above long-term historical averages. Central banks do not trade momentum. Their allocation decisions typically reflect long-term reserve management strategies. When central bank accumulation trends higher while retail participation remains subdued, it signals that institutional capital may be acting earlier in the cycle than individuals. This does not imply certainty. It does not suggest coordination. It simply reflects observable data. Official sector purchases have remained firm even as price levels rose. In previous late-stage bubbles, official institutions were often net sellers into strength. That difference is structural. He also considered sentiment. Market tops are often marked by confidence that risk has disappeared. The language around gold today remains mixed. Some commentators argue it is extended. Others frame it as a hedge. The narrative is not unified. The fragmentation contrasts with periods when consensus forms quickly around unstoppable gains. Skepticism at highs is not typical of final euphoric peaks. Of course, none of these signals eliminate risk. Price volatility at new highs is common. Breakouts can fail. Consolidations can be deep. But early-stage structural repricing often appears confusing rather than obvious. It lacks emotional clarity. It moves unevenly. It consolidates instead of accelerating vertically. He framed the core question differently. Is gold expensive relative to its past price, or is it adjusting to a new macro baseline? When global debt expands, when fiscal deficits widen, when currency volatility increases, and when real yields compress, long-duration stores of value tend to reprice gradually. That process can unfold over years rather than months. If gold were trading at $5,000 while leverage ratios in futures markets were surging, while retail margin borrowing was accelerating sharply, and while media coverage framed it as a guaranteed path to wealth, the structure would look different. Those ingredients would resemble prior bubbles. At present, the evidence points to something more balanced. Elevated, yes, but not universally euphoric. He also reminded himself that markets rarely peak quietly. Late cycle moves typically show extreme acceleration followed by equally sharp reversals. The current pattern reflects strength, but not uncontrolled expansion. Volatility remains present, but it is not disorderly. Participation remains broad, but not manic. The distinction between price and structure defines this phase. Price attracts attention. Structure determines sustainability. At $5,000, gold commands attention. Whether it represents exhaustion or repricing depends on how participation, yields, institutional allocation, and cross-asset dynamics evolve from here. In the next sections, the focus shifts deeper into those structural signals. Real yields, capital rotation, and central bank allocation patterns provide measurable frameworks. The next 72 hours may offer short-term confirmation signals, but the larger cycle depends on structural alignment. For now, the conclusion remains analytical rather than emotional. $5,000 alone does not define a bubble. Behavior does. And behavior, at this stage, suggests caution, but not euphoria. The real yield equation. He shifted the focus away from price and toward the variable that often matters more than headlines, real yields. Gold does not move in isolation. It competes with the return investors can earn after inflation. When real yields are rising sharply, holding gold becomes less attractive compared to interest-bearing assets. When real yields compress or stabilize, the competitive pressure eases. At $5,000, the surface story is the number. Beneath that surface, the structural story is the yield environment. Real yields are influenced by two forces: nominal interest rates and inflation expectations. If nominal rates rise faster than inflation, real yields increase. If inflation rises faster than nominal rates, real yields decline. Markets constantly reprice these relationships based on incoming data, CPI releases, employment reports, bond auctions, and central bank communication. He examined the recent trend. Real yields had previously reached elevated levels as policy tightened. The tightening cycle placed pressure on gold for a period, but tightening cycles rarely continue indefinitely. As growth slows or stabilizes, the pace of rate increases often moderates. In some cases, markets begin pricing in policy pauses before official changes occur. Gold often responds not to policy announcements, but to expectations. He observed that the sharp upward momentum in real yields had cooled compared to earlier phases. That cooling does not mean yields are low in absolute terms. It means the acceleration phase has slowed. Markets frequently react to direction rather than level. When the rate of increase in real yields decelerates, gold tends to stabilize or strengthen. This relationship is not mechanical, but it has appeared consistently across cycles. He then considered the debt structure. Sovereign debt levels are materially higher than they were a decade ago. Higher debt levels increase sensitivity to interest costs. When borrowing costs remain elevated for extended periods, fiscal strain grows. Markets recognize this dynamic. Expectations around long-term yield sustainability begin to shift. If investors anticipate that real yields cannot remain elevated indefinitely without economic pressure, they begin repositioning earlier. Gold does not require collapsing yields to perform. It often responds when markets believe yield ceilings are forming. He also looked at the term structure of rates. Short-term yields and long-term yields do not always move in sync. When curves flatten or invert, it often signals tightening conditions. Over time, curve normalization typically requires either falling short-term rates or rising growth. If growth does not accelerate significantly, normalization frequently occurs through moderation in rates. That possibility influences long-duration assets. In this context, gold acts as a sensitivity gauge to future policy flexibility. He avoided extreme conclusions. Yield cycles can reverse. Inflation can surprise to the upside. Growth can reaccelerate. Bond markets can reprice quickly. But structural repricing often begins when investors sense that a tightening phase has reached maturity. Another dimension he evaluated was currency stability. The dollar plays a central role in gold pricing. When the dollar strengthens sharply, gold often faces pressure. When the dollar stabilizes or weakens, gold typically benefits. Recently, dollar strength has not exhibited the same acceleration seen in prior tightening phases. Stabilization does not guarantee a sustained decline, but it reduces one source of resistance. The combination of moderating real yield acceleration and stable currency behavior creates a different backdrop than the one gold faced during peak tightening. He then assessed volatility. In speculative blow-off phases, price expansion becomes disorderly. Volatility spikes rapidly. Gold's recent move toward $5,000 showed strength, but volatility remained within historical ranges. That distinction suggests structural repricing rather than destabilizing leverage. He considered how institutional investors interpret these signals. Pension funds, sovereign wealth funds, and long-duration capital allocators typically focus on real yield trajectories over short-term price swings. If they anticipate a multi-year environment of moderate real yields and elevated fiscal expansion, gold allocations may increase gradually. Such positioning unfolds slowly. It does not resemble retail-driven surges. Importantly, real yield compression does not require rate cuts. It can occur through declining inflation-adjusted expectations or reduced upward pressure on nominal rates. Markets price forward-looking conditions before policy shifts are confirmed. If you frame the key observation carefully, the real yield environment no longer appears to be tightening aggressively. That shift changes gold's risk profile, but confirmation requires observation. The next inflation release, bond auction reception, and central bank commentary will shape expectations. If real yields resume aggressive expansion, gold may consolidate or retrace. If yields remain contained or gradually compress, structural support strengthens. He avoided prediction. Instead, he outlined conditions. If real yields trend lower over several weeks, dollar momentum stabilizes rather than accelerates, volatility remains orderly, then gold's move toward $5,000 resembles repricing rather than speculative exhaustion. If real yields spike unexpectedly, bond markets show disorder, currency strength accelerates sharply, then consolidation becomes more probable. Markets rarely turn at obvious moments. They turn when structural variables shift quietly. He emphasized that gold's performance is not independent of macro forces. It reflects them. At $5,000, the price reflects a market reassessing the long-term yield environment. The number itself is not the signal. The yield trajectory is. In the next section, the analysis shifts beyond yields and toward institutional allocation behavior, another structural layer that often differentiates early cycle positioning from late cycle speculation. Institutional allocation versus public attention. He moved beyond yields and toward another structural layer that often separates early cycle positioning from late cycle speculation. Who is buying and why? In financial markets, participation matters as much as price. When an asset enters a true bubble phase, participation expands rapidly across the public. Retail investors increase exposure. Media narratives become more uniform and optimistic. Leverage grows in visible ways. At major peaks, enthusiasm becomes broad and emotional. Gold at $5,000 does not currently display those characteristics. Instead, the allocation pattern appears more institutional than retail-driven. Central banks have continued adding to gold reserves over recent years at levels above long-term historical averages. Their motivations are not short-term price momentum. They manage currency reserves, balance sheet stability, and geopolitical diversification. Their time horizon extends beyond quarterly performance. He understood that central banks do not act in isolation from macro trends. When sovereign institutions adjust reserve compositions, they typically respond to structural shifts, changes in trade flows, currency volatility, debt dynamics, or geopolitical considerations. These decisions unfold gradually. They do not resemble speculative trading behavior. At the same time, public participation metrics remain moderate. Retail trading volumes in gold-related instruments have not reached extreme levels. Search interest, while present, does not show the explosive spikes often seen in speculative frenzies. Media framing remains mixed. Some describe gold as extended, others frame it as defensive. The narrative is not one of unanimous optimism. This divergence is important. If price were driven primarily by retail momentum, volatility would likely expand sharply. Instead, gold's movement toward $5,000 has been firm, but not chaotic. That suggests allocation adjustments rather than emotional surges. He also examined exchange-traded fund flows. ETF inflows have increased, but not at the pace historically associated with final-stage blow-off moves. In prior speculative peaks, inflows accelerated dramatically in short-time windows. Current flows reflect accumulation, not urgency. Mining equities offer another lens. In late-cycle enthusiasm, mining stocks often outperform the underlying metal due to their operational leverage. Investors chase higher beta exposure, seeking amplified returns. Presently, miners have participated, but have not detached dramatically from bullion. That relative restraint indicates measured positioning rather than aggressive speculation. He then considered portfolio theory. Large institutions typically diversify exposure when macro uncertainty rises or when traditional asset valuations appear stretched. Equity markets remain historically elevated by several measures. Fixed income faces structural questions regarding long-term purchasing power. In such an environment, gradual diversification into real assets can occur without public fanfare. Gold often benefits quietly during these phases. He was careful not to assign intent. Institutional buying does not guarantee future performance. It reflects strategic adjustment. However, early-stage cycles often begin with institutional positioning before public recognition follows. Another element he observed was derivatives positioning. While futures markets remain active, leverage metrics do not currently suggest extreme imbalance. Managed money exposure has increased, but not to historically unprecedented levels. That distinction matters because excessive speculative leverage can destabilize price structures quickly. In the absence of extreme leverage expansion, price trends tend to consolidate rather than collapse abruptly. He also evaluated the international dimension. Gold demand is not confined to one region. In several emerging markets, currency volatility has influenced demand for physical metal as a store of value. These flows do not necessarily reflect speculative behavior. They often represent risk management at the household or institutional level. When demand is diversified geographically, it reduces concentration risk. The broader question he asked was this: if gold were in a late-stage speculative bubble, who would be driving it? Retail enthusiasm appears contained. Leverage expansion appears measured. Institutional allocation remains visible. The combination suggests that structural repositioning may be more influential than speculative momentum. That does not remove risk. Allocation shifts can pause. Policy surprises can alter trajectories. But structural cycles rarely peak before public participation accelerates significantly. Historically, final peaks involve narrative clarity, widespread belief that price will only move in one direction. That sentiment is not dominant. He also noted that skepticism remains present in professional circles. Analysts debate sustainability. Commentators question valuation. This environment contrasts with unanimous optimism typically observed at major tops. He framed the distinction carefully. Price can rise without widespread excitement. When that occurs, it often signals early or mid-cycle dynamics rather than exhaustion. But structural signals require confirmation over time. If institutional allocation continues while public participation remains moderate, the imbalance persists. If retail enthusiasm accelerates rapidly and leverage expands, the structure would change. For now, the participation profile appears asymmetrical. Institutions adjusting gradually, individuals observing cautiously. In financial cycles, asymmetry often precedes acceleration, but only if macro variables align. In the next section, he turns to a final structural layer: cross-asset valuation spreads. Because sometimes an asset does not look expensive in isolation. It looks differently priced when compared to alternatives. Cross-asset imbalance and relative valuation. He shifted the analysis away from gold itself and toward its position inside the broader capital system. Price alone can mislead. An asset may appear expensive when viewed in isolation, yet look differently valued when compared against alternatives. In macro cycles, relative pricing often matters more than absolute levels. At $5,000, gold looks historically high in nominal terms. But nominal price does not account for what other assets are doing at the same time. He began with equities. Stock markets remain elevated relative to long-term earnings trends. Valuation metrics, while debated, sit above historical averages in many developed markets. When equity valuations compress, capital often seeks stability or diversification. That transition does not always occur through panic. It can begin gradually through allocation adjustments inside large portfolios. The key is the relationship between gold and equities, not the standalone chart of either. One of the simplest measures is the gold-to-equity ratio. Historically, during periods of financial stress or macro uncertainty, gold outperforms equities, and the ratio rises. During periods of strong growth and risk appetite, equities tend to outperform gold. The current ratio, while improved from prior years, does not sit at historical extremes that marked previous macro turning points. That suggests relative pricing is still in transition rather than exhaustion. He then considered bonds. Government bonds traditionally compete with gold as defensive assets. When bond yields are attractive in real terms, investors often prefer income-producing securities. When real yields compress or fiscal pressures increase, bonds may not provide the same confidence. In such conditions, gold becomes an alternative store of stability. The comparison is not emotional, it is mathematical. Investors compare return profiles adjusted for inflation risk. He also examined currency dynamics. In an environment where multiple major currencies experience volatility, gold functions as a neutral asset, not tied directly to any single sovereign balance sheet. When currency confidence fluctuates, even modestly, incremental allocation shifts toward gold can occur without creating speculative frenzy. That incremental movement often feels quiet. It does not resemble the urgency of retail-driven cycles. Another structural layer is liquidity distribution. In highly leveraged environments, liquidity flows disproportionately into growth assets. When liquidity becomes more selective, diversification patterns change. Capital allocators rebalance portfolios not because they predict collapse, but because risk-adjusted return expectations evolve. He avoided framing the shift as dramatic. It is not about abandonment of equities or bonds. It is about marginal reallocation. When trillions of dollars move even slightly, price adjustments in smaller asset classes can be significant. Gold's market size is smaller relative to global equity and bond markets. That means incremental allocation shifts can influence price levels materially without requiring speculative mania. He then looked at volatility dispersion across asset classes. Equity volatility has shown episodic expansion, while gold volatility has remained comparatively orderly. When defensive assets hold steady during equity turbulence, portfolio managers take notice. Stability itself becomes a signal, but stability at highs also requires scrutiny. He examined whether gold's rise had detached significantly from underlying macro conditions. In speculative peaks, price tends to accelerate far beyond structural drivers. Current movement toward $5,000 has been strong, but not vertical. Consolidations occurred along the way. Pullbacks were absorbed rather than ignored. That pattern aligns more with repricing than with exhaustion. He also considered inflation-adjusted comparisons. When nominal price reaches new highs, it is important to assess purchasing power equivalents. Adjusted for inflation across decades, previous peaks look different than raw nominal charts suggest. In that context, $5,000 reflects both currency dilution over time and structural repricing, not simply speculative excess. Still, caution remains necessary. Relative valuation can shift quickly if growth expectations re-accelerate sharply, or if productivity gains alter earnings trajectories. Equity markets could justify higher multiples. Bond markets could stabilize further. Currency strength could return decisively. Cross-asset relationships are fluid. But at this stage, gold's position relative to other major asset classes does not reflect universal overextension. Instead, it reflects adjustment within a broader system experiencing structural strain, elevated debt, fiscal expansion, shifting reserve strategies, and moderate real yield dynamics. He framed the key observation carefully. Gold does not appear isolated in exuberance. It appears integrated within a wider rebalancing process. If cross-asset volatility increases while gold holds firm, the relative case strengthens. If gold weakens sharply while alternative assets accelerate sustainably, the structure changes. Markets rarely send single variable signals. Confirmation often requires alignment across assets. At $5,000, gold commands attention. But when viewed against equities, bonds, currencies, and liquidity distribution, it does not yet exhibit the imbalance patterns that historically marked final speculative peaks. In the next and final section, the focus turns to near-term confirmation signals, not predictions, but measurable indicators that will determine whether this phase consolidates into continuation or transitions into retracement. Because in structural cycles, timing matters less than alignment. The confirmation window, what validates structure? He reached the final stage of the analysis by narrowing the lens. After examining yields, institutional behavior, and cross-asset positioning, the remaining question was not whether gold could continue higher. The question was simpler and more disciplined. What would confirm that this is structural repricing, and what would invalidate it? Markets rarely move in straight lines. Even early cycle advances experience consolidation, retracement, and volatility expansion. Therefore, confirmation does not mean uninterrupted upward movement. It means alignment across key variables. He began with real yields again, but this time from a confirmation standpoint rather than a directional one. If real yields remain contained or gradually compress over the coming weeks, it supports the thesis that monetary conditions are no longer tightening aggressively. However, if real yields begin accelerating upward with momentum, that would pressure gold's structure. It would suggest that the macro headwind has returned. The second variable is currency behavior. Gold often responds to broad dollar trends. Stability or moderate softness in the dollar can coexist with firm gold pricing. But a sharp sustained dollar rally typically challenges gold's strength. If the dollar strengthens significantly while gold remains resilient, that resilience becomes informative. If both move in opposite directions as expected, the structure remains conventional. He then focused on participation shifts. Early cycles often show steady, measured inflows. Late cycles show abrupt surges. If ETF inflows increase gradually while volatility remains controlled, it indicates disciplined allocation. If inflows spike dramatically in short windows alongside leverage expansion, the character of the move changes. Behavior reveals phase transitions. Another confirmation layer lies within equity markets. If equities remain stable or rally moderately while gold consolidates above $5,000, it signals diversification rather than flight. If equities experience heightened volatility and gold absorbs capital calmly, the relative valuation thesis strengthens. But if gold weakens during equity stability without macro explanation, it may suggest exhaustion rather than repricing. He also examined derivatives positioning. Futures markets offer insight into speculative intensity. Extreme leverage accumulation often precedes destabilizing reversals. As long as positioning remains within historical norms, the structure appears balanced. If positioning becomes heavily concentrated and one-sided, fragility increases. He was careful not to treat any single indicator as decisive. Markets operate through clusters of signals. Confirmation comes from convergence, not isolation. Time also plays a role. Structural repricing requires consolidation. If gold stabilizes above previous breakout levels over multiple weeks rather than days, it reinforces strength. Sustained consolidation often signals accumulation. Sudden vertical acceleration followed by rapid reversal would suggest a different character. He reframed the 72-hour window not as prediction, but as observation. In short windows around major data releases, inflation reports, central bank communication, bond auctions, markets reveal sensitivity. If gold reacts to negative data but recovers quickly, it indicates underlying demand. If it fails to respond positively to supportive data, it signals weakening conviction. Resilience can be more informative than rally. He also addressed risk discipline. Structural analysis does not eliminate uncertainty. Price can retrace sharply even within longer-term repricing phases. Volatility at new highs is common because markets test conviction levels. Investors who misunderstand this often mistake consolidation for collapse or strength for inevitability. Position sizing and time horizon define outcome more than entry precision. He emphasized that gold at $5,000 is not a final verdict. It is a checkpoint within a larger system adjusting to macro realities. Debt dynamics, monetary policy flexibility, currency diversification, and cross-asset valuation spreads are ongoing processes. They evolve slowly. If over the coming months, real yields remain stable or moderate, institutional allocation persists, retail enthusiasm stays measured, cross-asset volatility remains balanced, and gold holds above structural breakout zones, then the evidence supports early-stage repricing rather than speculative excess. If instead, yields accelerate sharply, participation becomes euphoric, leverage expands rapidly, cross-asset alignment breaks down, then the structure shifts toward caution. He concluded with a simple distinction. Late-stage bubbles are loud, early-stage structural cycles are debated. At $5,000, gold is debated. Analysts question sustainability. Investors assess allocation weightings. Institutions adjust gradually. That environment reflects analysis, not mania. Markets move in phases. Recognition often arrives after structural alignment has already occurred. The purpose of analysis is not to predict exact price levels, it is to understand phase. For now, the structure beneath $5,000 suggests measured repricing within a changing macro system. Confirmation will come not from headlines, but from alignment across yields, participation, currency stability, and cross-asset behavior. Price attracts attention. Structure determines durability, and durability is revealed over time. The discipline layer. Behavior in a structural market. He closed the analysis by shifting from markets to mindset. Structural cycles are rarely obvious in real time. They unfold through layers: yield adjustments, institutional positioning, cross-asset rebalancing, and gradual narrative shifts. But even when the structure appears aligned, execution becomes the deciding factor. Markets test conviction. At $5,000, gold presents two psychological pressures simultaneously. For those without exposure, the fear of being late grows stronger. For those already positioned, the fear of losing unrealized gains increases. Both reactions can distort decision-making. He understood that structural analysis loses value if behavior becomes reactive. The first principle he considered was time horizon clarity. Short-term traders operate differently from long-term allocators. If the objective is short-term price movement, volatility must be expected and managed actively. If the objective is long-term capital preservation or macro diversification, short-term fluctuations become less decisive. Confusion between these horizons creates unnecessary stress. Structural repricing rarely moves in straight lines. Consolidation phases often feel uncomfortable because they occur at elevated levels. A retracement after a breakout can appear alarming, even when it remains within historical norms. Investors who mistake normal volatility for structural failure often exit prematurely. He emphasized that discipline does not mean stubbornness. It means defining risk before emotion enters the equation. Position sizing plays a central role. When allocations reflect a measured percentage of total portfolio value, volatility becomes manageable. Overexposure magnifies emotional reactions. Underexposure can create regret-driven decisions. Balance reduces both extremes. He also reflected on diversification logic. Gold is rarely intended to replace all other assets. It functions as a complementary allocation. In structural cycles, its role often expands gradually as macro conditions justify it. That expansion should follow strategy, not headlines. Markets reward consistency more than urgency. Another behavioral element is information filtering. At milestone prices, commentary intensifies. Opinions become more polarized. Some predict dramatic continuation, others predict immediate reversal. The volume of analysis increases, but clarity does not necessarily improve. He understood that structured indicators, yields, participation metrics, cross-asset ratios, offer more stability than narrative extremes. Data evolves incrementally. Headlines shift hourly. He also acknowledged uncertainty openly. Structural alignment increases probability, not certainty. Unexpected variables, geopolitical shifts, growth acceleration, policy changes can alter trajectories. The purpose of disciplined analysis is not to eliminate uncertainty, but to operate within it responsibly. He returned to the core distinction introduced earlier: price versus structure. If price alone drives decisions, reactions become impulsive. If structure guides decisions, adjustments become measured. At $5,000, price commands attention, but structure still determines sustainability. He framed a practical closing observation. If gold consolidates calmly above breakout zones while macro variables remain aligned, the structural case strengthens quietly. If volatility expands dramatically alongside euphoric participation, caution becomes appropriate. Neither outcome requires prediction. Both require observation. Markets reveal phase shifts through behavior, not declarations. He ended with perspective rather than forecast. $5,000 is not a finish line. It is a reflection of accumulated macro pressures, policy shifts, and allocation adjustments. Whether it marks an early stage or a mature phase depends on alignment across yields, institutional flows, and cross-asset dynamics. The disciplined investor does not chase headlines. He defines allocation, observes structure, and adjusts gradually as evidence evolves. In structural markets, patience often outperforms urgency, and in long-duration assets, durability matters more than drama.